Get started. All right. So for those of you who have not met me, my name is Ivory. I own Insight Strategies. We are a credit repair organization based in downtown Vancouver, Washington. So we also help people all over the country when it comes to their credit. So I've been in this space in multiple different facets in regulatory compliance with defaults, a bit of time in underwriting on the mortgage side, and much, much more. So background is pretty vast. My goal is to make sure that you leave here today having tangible information that's usable, that helps you in what you do. And that brings me to what today's topic is. So today we're going to go over how to read a credit report and how to handle clients with no scores. Now we're going to really be pretty high level and then narrow down in scope based on some of the questions that were submitted. So if there's something more that you would like me to go into, please definitely let me know during the process. So why are we here? Number one, you may not know how to read a credit report, and nobody's probably taught you exactly how to do it in a way that can help you close more loans. And if you know the secrets of the credit formula, the different algorithms and how they vary, that can definitely help you in closing more loans. And you can gain the tools and resources necessary to become an expert, allowing you to close loans that nobody else can by having this knowledge base. So most importantly, we lose a lot of clients from the time that they inquire about getting a mortgage to actually hitting the closing table. So only about 35% of applicants close. And the primary issue we see is from credit history and debt to income issues. And credit and debt to income go hand in hand. Typically, if you are somebody who has a lower credit score, you often have a higher debt to income ratio. And this is simply because you're going to have predatory loan products or predatory lending in general, right? High interest rate auto loans, credit card interest rates that are very high. I've seen auto loans over 30% and credit cards over 75%. It's insane out there. So there's not a lot of protections for consumers who do have those lower scores. So I'm going to start off with one of the first questions submitted. What is the easiest way to get out of debt, raise the credit score, and get ready to purchase a home? So again, this is one of the first questions we had, and we're in an age of one size fits all. We see this especially in the investment world, the insurance world, the lending world, and even the credit world that I'm in right now. It's a pretty dangerous premise. So there's often general best practices, but each situation has its own nuances based on several personal factors on the credit report itself. So today I'm going to touch on certain scenarios, but with most things, everything is very scenario specific. So you'll gain some knowledge today that's going to help you in identifying what's impacting the score the most, so that way you can then determine the best approach for your specific client. So just wanted to throw that out there. I will answer this question the best I can throughout the webinar today. So again, if you have a specific scenario you want to go through, just let me know. So how fast can you get credit scores up was another big question we had. It's going to depend. There are some solutions that can impact the credit report in less than 30 days. And so throughout today's webinar, we will go ahead and we'll look at some of those quick solutions, and then we'll look at some of those long-term solutions. So if you're looking for a quick 10 points, there are always options available. But if you're looking to help your client get their score, from the 500s to the 700s, that's going to be a lot longer of a road than just getting those couple of points. All right. So knowing how to read the credit report, that's going to help you get scores up faster. So how do we, when we're looking at how to read a credit report, some of the main things that you want to start with as basic knowledge is how to identify what accounts belong to what borrower. So on the lending side, you're getting a tri-merge credit report. And if you're pulling multiple borrowers' credit at once, it's going to show you everything consolidated into one report. So we'll look at some examples too, but that's a big important factor. Knowing how to identify what accounts are reporting to what credit bureaus. Not every account you see on the credit report is going to report to all three credit bureaus. So the different actions you take, so the actions you take may vary, right? If you have a negative account showing only on one bureau, it may not be as important as another negative account showing on 3 credit bureaus. Or let's say some of these smaller credit card companies might only report to 2 versus 3 bureaus. So if that client's utilization is an issue, you may prioritize a different account if they don't have the funds available to pay everything down. So the other thing we're going to look at is knowing what you should advise your borrower to pay versus what you shouldn't advise them to pay. For example, medical collections. Paid medical collections now come off the credit report. It's good to advise your borrower to pay those, especially if they are small dollar amounts. Charge-offs. Telling your borrower to pay a charge-off is not a bad option, especially if it is a newer charge-off. This is going to prevent it from being sold to a third-party collection agency and then having their credit report get impacted a second time, once for the original charge-off and again for that new collection being added on there. In addition, once that charge-off is paid, it doesn't have to be the full amount, could be a settlement, you will see a bump in the credit score. The same is not true for other types of accounts like non-medical collections. And then another important thing we'll be looking at is knowing when to advise not to close an account. So if you have a borrower who has been really working hard, they've been paying down their credit cards, one of the worst things you can tell them to do is close all those accounts once they're paid. You are going to see their score drastically decrease. So very important thing. If you walk away from here with a couple of things, this one page, this one slide would be something to remember. And then if you're identifying derogatory student loans, things that are in collections, advising your borrower to contact U.S. Department of Education and rehabilitate those loans. Now, unfortunately, we are in a pause on rehabilitations with no ETA on when they're going to resume. So I don't have too much of an update there, but if you're here, you'll be on my email list. So once rehabilitations resume, I will let you know. And then learning how to read the score factors. So we'll take a look at what that is and what that really means here in a little bit. Okay, so we're going to look at it right now. So let's look at the report score factors. So score factors. Every single one of the credit reports you pull, no matter where you're getting your reports from, has score factors on there. So these score factors are your legend. They're your key. They're telling you exactly what is pulling this borrower's credit score down. So each borrower will have this on the report. So if you've got 2 borrowers, you'll see one for each bureau for each borrower. And then it's going to tell you the version of, let me make it so you can see my mouse here. Okay. Then it's going to tell you what version of the credit score is being pulled. So this is really good for your conversations with borrowers who can't seem to understand why the score is different. You can simply tell them, look, it's FICO, Fair Isaac. It's FICO version 2. When you're looking on Experian, you can have them pull up their Experian app. It says FICO version 8. It will stop all of the confusion right there. There's multiple versions of the credit score. But in the mortgage side, you're using FICO Classic. So this is a good way to help your borrowers understand, if you're allowed to show them this part of the report, that is. Okay, so once we look at each bureau, you're going to see anywhere from 3 to 4 items listed. These little numbers are just codes. You don't really need to worry about them. They're the status codes. What really matters is the information that's displayed here. So this is ranked in order from what is most impactful to the credit score to what is least impactful to pulling the credit score down. So for this individual, you can see that they haven't had a long established history. Length of time since accounts have been established is too short. So you are rewarded for having longer history. So someone in this situation, let's say they have a parent who has an 800 FICO. This is a perfect solution, a perfect time to have the solution of having them become an authorized user on that parent's credit card that has a low balance and a good utilization ratio with good payment history. Right there, depending on how thin this person's credit file is, meaning if they don't have a lot of history, you can see double-digit jumps in the credit score pretty quickly. Timeline is just going to depend on when that creditor reports. Now, the second biggest factor for this specific example is level of delinquency on the accounts. So that means they've had some pretty severe late payments or even collections or charge-offs. The client can either work on credit repair themselves or hire a third-party agency to do it. I mean, there's really no way around level of delinquency other than removal of negative accounts. So that's going to be a scenario where, okay, if you can't control or do something here for the consumer, then you got to send them off to somebody who can, or they can try it themselves. Too many accounts with balances, pretty self-explanatory. They need to pay down their credit cards. So this is going to be specific to credit cards, not loans. So let's say you have a borrower that does not have the funds to be able to pay down the cards, or it's going to negatively impact their ability to get the loan, make it harder. If their score is high enough with this individual, then you can have them transfer it into or roll it into, consolidate it into a personal loan, right? So the reason I mention this is because the credit score algorithm is looking at the utilization ratio specific to revolving debt. So if you're able to move the balances to an installment loan, one, they're going to pay it off faster. Interest rates are pretty high on consolidation loans right now, but they're still better than a credit card. You're going to see once that balance is moved over, a jump in the client's credit score from that. So being creative can sometimes get you the solutions that you need when it comes to improving the credit scores and getting them to that mode of being able to qualify. Number of accounts with delinquency, same as the second one, right? It's got to be deleted. That's really your only solution there. Delete it or just time going by. And then too many inquiries. This is honestly not going to be worth too many points. It's about 10% of the credit score. Nothing you can do there either. So hopefully this example was fairly helpful. Anyone have any questions on what we're seeing here? Okay. So this will be on all of your credit reports. You're likely scrolling past it. But I don't even see the credit report, and I can tell the client what to do just from this. So it's a very, very useful tool. All right. Okay, so here's another example. This is, in this case, you can see this client, excuse me, has really strong scores. We've got 795, 777, 784, right? High credit scores. This is just to show you that unless you have a perfect FICO, there's still going to be something pulling the credit score down. So if you have a client who, looks fine, but they're still asking you what's going on, here you can go right to the score factors and you can tell them, these are the few things keeping you from a perfect credit score. Okay. Now, another reason we're here today, when there is no credit score. So we'll look at how to create a credit score later on. But what's important to understand is you may see your score factors look like this, and there still may be items on the credit report. So not scored, no qualifying account. Now, no qualifying account could mean that there are accounts on the report, but they've been closed for more than 6 months. So we don't have any payment history over the last 6 months. So therefore, no score is being generated. The credit score algorithm wants to be reliable. Old data is not reliable without new data also existing. So essentially, the algorithm wants to say, yes, they may have paid well or paid accounts on time in the past, but what is their current situation? So without that data, it's not comfortable with placing a risk assessment on that consumer. So, okay. So this example, what I really want to point out here is just these two second and third factors showing up: lack of recent revolving account information and lack of recent revolving information. So basically the same thing for number 2 and number 3. If you tell this client to open a credit card, their score is going to likely jump into the 600s. I can confidently say it'll go into the 600s. just because they're missing revolving debt. The algorithm is looking for credit mix. It wants to see that the consumer has an ability to pay multiple types of debt. The other thing is they're not getting any positive impact from the utilization ratio because there's no credit, no revolving debt extended to them. So you'll see a pretty sizable jump in score if you see something like this. You've got a client who just doesn't have any open and active credit cards. They absolutely don't need to be using them more than once every 6 months. They can do a $10 charge or just buy gas one time on it. Just again, remember every 6 months, we need history within the last 6 months so that it can help calculate into the score. So that's all that would be needed in this scenario for this client to all of a sudden meet those minimum requirements for being at the bottom of qualifying for many of the loan products out there. Okay. Any questions about the score factors before I dive into our next question? All right. I will take silence as a good thing. Okay, so the next question is, what is the best way to dispute late marks? So here's an example of what I see often, and I'm going to explain what's going on here, but disputing late marks is one of the most difficult things to do. So I discourage consumers from trying to do it themselves just because they're going to be banging their heads against the desk. They absolutely can, don't get me wrong, but it's not a fun task. It's arduous and it takes a lot of persistence, excuse me. So there are a couple, I would say, best practices when it comes to your ability to get a late payment removed from the credit report. So I'm going to rank them in order. Number one, mismatching payment history. So when you see a tri-merge credit report, you don't get to see the differences like this. This is what I get to see on my end. I get to see the differences. So this is a client of ours, right? And we see this report, clearly the history does not make any sense, right? We've got a 30-day in January 2022 for Equifax only. No data for December 2021 in TransUnion, on time on Equifax, but then past due and Experian. All this mismatching history is a gold mine for credit repair, right? Because the Fair Credit Reporting Act says, loosely says, I mean, the wording is very different than this, but everything must be accurate on the report, right? Therefore, if we see inconsistencies in reporting, we can argue a lack of accuracy, right? So that allows us to get this January 2022 removed, December 2021 removed, September 2021, the possibility of October, only because we have no data from Experian, and then what's left is just one late mark for November 2021. So that's the potential for several removals for this client. Now, if this wasn't sandwiched like it is, where we've got late in the beginning, in the front and the back end, we might have the chance of removing November. So in other scenarios, let's say the consumer is just showing past due for, let's say, June 2022. And then we request the statements from the consumer and we ask them for the May, June, and July statements. And we find out based on the statements that were actually past due in May, but the bureaus marked them as past due in June. This is fairly common. Bureaus often are getting the data the following month, and then they end up marking the delinquency in the wrong month. So we can simply prove that they were actually on time during the month that the bureau has incorrectly marked them past due to get that removed. Now we're not going to give them the statement showing they were actually past due in May, because why would we do that? The whole goal is to get rid of the bad information. So anything mismatching, whether it's based on the statement versus the report, or like what you see in this example, are really good ways to get late payments removed. If you have a consumer or client, that let's say has never been late before and they get one late payment, there's a possibility of getting what's called a goodwill removal. But honestly, it's pretty much a 50-50, and they better have a really, really good case. Something, you got to pull at the heartstrings to typically see a success there. Now, separate from the mismatching history or anything that has to do with the Fair Credit Reporting Act, due to the CARES Act, any late payments from January 2020 through May of this year, or until May of this year, excuse me, if the client has had some sort of a modification, forbearance, deferment, any sort of an accommodation, even a late fee waiver that allowed them to become current, the late payment that had that accommodation can be removed from the negative reporting. So the key is it must have caused them to be able to become current. So if they had a late payment waiver and they still didn't catch up on payments, not going to do anything. But because of the CARES Act, there are other opportunities for valid late payments to be removed from the credit report if there was an accommodation. So, okay, what's the best way?
I have a question on
oh, sorry, go ahead.
So in the instance where there's only like September of 21, only one 30-day late, on the report that we see, are we going to see that 30-day late, and it's going to look like it applies for all of them, and so therefore it counts?
Oftentimes, yes. You're not really going to be able to tell the difference. Sometimes what you'll see is it might say, like I just saw in a report this week from a lender, it said, like in the table, it will say like 2 30-day lates, 3 90-day lates, 2 60-day lates, but then it only gave 2 dates of late payments in the date section.
Okay.
So it's like, well, obviously there's something wrong there.
Yeah.
Perhaps the account is older now, and some of those late payments should have aged off the report, which is why the dates aren't there. So they're being improperly penalized for data that should have aged off the report. So that is probably the only way you're going to be able to tell the difference on your end.
Okay.
So
cool. Thanks.
Yeah. So what's the best way to treat charge-offs and repossessions? And sorry, I literally just copy and pasted the questions. I could have edited them for grammar, but here we are. So the best way to treat a charge-off, and I did touch on this a bit at the beginning, or a repossession, is getting the balance updated to 0. One, again, we want to prevent the sale of the account from the sale of the account to a third-party collection agency. We don't want that double jeopardy happening, impacting the score even further. So if that consumer can do a settlement on the account, get the balance updated to 0, that's going to at least help the score a bit. Ultimately, the ideal goal is get it deleted from the credit report. Again, that's going to take credit repair or for themselves or hiring a company like us. But at least getting it paid off will have a positive impact, especially if it was a credit card, because then we see that the utilization ratio is being impacted. And it's anything that's a closed account that has a balance impacts this category adversely. So if it can be updated to 0, it certainly will help. And this is the factors of the FICO credit score, so that we're working with, and the whole idea is to influence each of these categories. So quick and easy answer on that one. How can clients remove inquiries? So a lot of clients have irrational fears of inquiries. Inquiries really aren't that big of a deal. They're not worth that many points. And especially in the mortgage space, there's a lot of rules about inquiries. I'll just put it that way, because it can get fairly complicated, but any inquiries on a mortgage within a 45-day time frame are only impacting the credit as one inquiry. The score impact is actually suppressed for the mortgage inquiry pull for 30 days from the pull as well. So just a heads up, it's not worth too much. Now, clients may find issues in other lending spaces where excessive inquiries, there are policies with some credit card companies, for example, where an excessive amount of inquiries will disqualify them because they don't know if new debt has been taken out that they can't see on the report yet. So, but the actual point value is very minimal. So let me go to the slide here. So new credit makes up inquiries and newly opened accounts. So inquiries is only a portion of this 10%. It's worth very little. So can they get it removed? Yeah, it's basically just an argument back and forth with the Bureau, but does it really have a big impact? No, it really doesn't. So we do remove inquiries for our client base, but that's usually just because if we're 1 to 2 points away from them qualifying, or from there being a break in the interest rates, then we just want to make sure we're influencing every 1 to 2 points we possibly can, but it really shouldn't be a huge factor. Now, inquiries do remain on the report for 2 years, but only inquiries within the last year affect the score. And you can have 4 inquiries per bureau before you see any negative impact to the score. So hopefully that answers whomever's question that was. All right, switching gears from reading credit reports, and I'm happy to pull up reports once we're done with this section too, if you want to just go through a report line by line. I've got some redacted reports we can look at too. But let's go ahead and move into how do you help clients build credit? So this question was submitted, and the ideal way to help clients build, like create a credit score or build credit is to influence each one of these score factors. So the more we can influence, the bigger an impact we have on either improving the credit score through the credit building side, or establishing a credit score at a really high starting point, right? So clients that follow our credit building plan or people who just buy it on the internet usually start in the 700s with their credit score because we're able to tackle each of these aspects. So let's look at the different ways. So we like to use a blend of non-traditional reporting to establish credit with some traditional credit building tools, because again, we want to influence each of these factors. But if you're getting a mortgage, we don't want to open a whole bunch of debt unnecessarily, because why? What's the point of that? We don't need to create an issue with debt to income unnecessarily. And that's where the non-traditional reporting comes into play. So I can send, if you want this information, if you want me to send you a copy of our credit building plan, we typically sell it, but I'm happy to send it to you and you can use it with your prospect base. Shoot me an email after this. My contact information will be at the back end, or feel free to put your email in the chat and I'll make sure I get it to you. But a great way is adding their rental payment history to the report. We use a service that only costs our clients $25 to add 2 years. So I can get you that link. Most of the companies charge $200 to get the 2 years. Here's the important thing. Remember, we talked about needing 6 months of history in order for a score to be populated. So if you have someone with no credit history and they just open a credit card, well, that's great. The credit card is wonderful because it influences so many pieces of this puzzle, right? We've got amounts owed, which is just utilization. We've got payment history. We've got credit mix being impacted. So, I mean, all of these great factors, and, it takes time to build length. But unless there's 6 months of history, there's still no score. So we have to establish 6 months of history somehow. And so the non-traditional reporting will help you do so. So you can add the rental payment history, and then you can also add utility bills and subscription services. So a lot of you have seen Experian Boost on the credit reports. It's extremely useful because it's free. It's only going to help Experian. We have another one that'll add it to TransUnion and Equifax. But again, that's going to create that 6 months of history that's needed. So when they open that credit card, it immediately impacts their score because we've got the history. Okay. If somebody is coming from a place of credit damage, the secured credit card is the best way to achieve that. And then if they just don't have any history at all, they're not going to want to apply for an airline credit card, right? They got to start from the beginning, the credit cards that are geared more towards someone establishing credit. It does not have to be secured. There does not have to be a deposit if they have no credit, but they can't start, at the top tier credit card. They just won't get approved for that. Another great way to establish the history and influence literally every factor is the authorized user accounts that I had mentioned earlier. So if they have a family member or a spouse that has great history, being added as an authorized user can help kickstart their credit profile. It's never as good as having your own account, of course. So it's not a permanent solution, but it's certainly a huge additive to really boost the credit score. So if you want somebody to start off with a great credit score, best thing you can possibly do is add the rental payment history, add the utility bills and subscription services, have them open a credit card, authorized user account. That's it. That would be perfect. Now, sometimes authorized user account's not an option. Sometimes their bank won't work with the services like Experian Booster, the Grow Credit services to add subscription services and utility bills. Sometimes they pay their rent in cash, so we can't get it added to the report. So if that's the case, then there are other options like credit builder accounts. And a credit builder account is a savings account that reports like a loan on your credit report. So you pay into it monthly, usually $25. So again, not going to impact debt to income too much. And then each month it reports an on-time payment. At the end of the term they choose, they get all the money back. They helped their credit and they got the teeniest amount of interest on that account as well. Oh, I missed some chats. Oh, it's just emails. Okay, perfect. And then also getting that secured credit card, right? There's still no other good way other than, you have to open your own credit still. But the credit card's not going to impact debt to income if they're not excessively using it. So that's going to be my quick hit way to do it. And then again, I have the playbook that I'll give to you for everyone who submitted their emails. So, last thing, rule of thumb, ideally 3 items open, 6 months of history. Just remember those things. Okay. Any questions on building credit? Okay. There we go. So what about credit repair and should you use it for your clients? The short answer is maybe. Not every single one of your clients will need credit repair and some just won't want it. And that's okay. So being able to have these options at your fingertips is super, super helpful because you can still improve the scores, one, by looking at those score factors we talked about, giving some guidance there, and then getting them to add good information onto their report to help positively influence the score factors will help. It's going to get them somewhere. It's not going to get them as far as removing derogatory information, but it certainly can do a lot for your client base. Now, the important thing about credit repair is finding a good company. Obviously, I own a credit repair company. You certainly do not need to use our services, but whomever you do use, I implore you to do some good research on who they are. Unfortunately, this industry is pretty scammy. You do want to make sure everything they're doing is above, is allowed, legal, and ethical. So there's a bit of an issue in this industry, unfortunately, and hopefully it will change over time. But at the moment it has not. So with our process, we do offer a free consultation. You have a report for the client. We will review it with them line by line. If they choose to work with us, they get a credit analysis and then a credit establishment plan. So it's going to go over this information. And then we have a 30-minute meeting with them to explain, okay, these are the exact steps I want you to take. And here's why you should take these steps. We prioritize what things they should pay, what things should be refinanced during the course of the credit repair process, and at what credit score range they should be doing